All right, if you don't mind, let's start off talking about your results just a bit. So stocks moving a bit lower since earnings. One of the reasons is you actually lowered your full-year fee and commission guidance. It was 810 to 830 million. You lowered it down to 775 to 825. You get about 40% of revenue from fees. What made you what led you to that move, I should say?
Yeah, so we lowered the range. It's very volatile right now. So if you look at the trading revenue in the first quarter, January was a great month. February, as the tariff discussion started to emanate from the executive branch, you saw more and more uncertainty among the trading groups. So February and March were very slow months for us. April has rebounded. So we'll see. What we did was we lowered the range. It's not easy to forecast that segment for us very well. But if you look at the other areas of fee business, we had very strong. Our fiduciary asset management business grew over 10%. Year over year. So mortgage, despite a very tough market, is still growing for us. Our transaction card business is growing well. So the trading revenue was really the miss for us this quarter.
You know, Stacey, we were really excited to talk to you to kind of get out the bubble of the coast and kind of get to the middle of the country. You have a big business and what a lot of people call the Sun Belt. So I did want to ask you, when we're talking about economic activity in those areas, you loan to healthcare businesses and energy businesses. How are they seeing things? We were just looking at some of the data here at CNBC, and on about 90% of earnings calls, we're hearing companies talk about recession. The companies that you work with, how are they seeing the economy?
Absolutely. Well, our base case at BOK Financial is not for a recession. If you look at our geographic footprint, we're in some great metropolitan markets. Dallas, Houston, Denver, Phoenix, Oklahoma is growing very well. So we're in a great regional footprint, and our borrowers are still very optimistic. Clearly, all the discussion around tariffs and what the impact of that's going to have has created some uncertainty. And there's been a little bit of pause in economic activity. But for the most part, our borrowers are still very positive about the outlook.
All right, so you're positive about the outlook. One other thing, you reaffirmed your provision expense. You kept it the same, saying that credit looks very strong. It seems like in this environment, as you mentioned, you're mentioning a lot of the uncertainty. Why wouldn't you want to increase those provisions? Why wouldn't you want to give yourself some more cushion?
Well, we have very healthy reserves to start out with. If you look at the history of BOK Financial, particularly the recent history, we were the largest bank in the United States that didn't participate in TARP because we had extraordinarily strong credit outcomes relative to the market back during that period of time. So we are very strong from a credit underwriting perspective. Our discipline there is very strong, and we have a 1.4% allowance, which on a relative basis, particularly compared to, I think we had 2 basis points of charge-offs this quarter, is very, very strong. And so even as we look forward, our forward-looking unemployment base case for the end of the year is around 4.5%, between 4.5% and 5%. And so that's very doable inside the allowance that we have today. Not worried about credit today. Credit is unsustainably good, and we're not anywhere close to really a reversion to normal.
I'm asking a lot of tough questions, Stacey, and again, we were very excited to talk to you just because of the region that your bank represents and the people that you cover. But I do want to point out a highlight from your report. You were able to expand net interest margin, a very key metric for profitability for every bank. What was the catalyst for that?
Well, we've done a very good job of controlling deposit costs. We have a very strong liquidity base that's allowed us to manage deposit costs in an environment. In the first quarter, the Fed wasn't moving. We continue to be able to slowly move deposit costs down, which allowed us to expand our net interest margin. The other piece that's different for us is we have a very short duration securities portfolio. So that securities portfolio is repricing more rapidly than maybe other regional peers or other larger banks are able to reprice because we've got about a 3 to 3.5 year duration of that portfolio. So that fixed income portfolio is repricing more quickly. That's also helping us expand our net interest margin.
One other question for you. When we're talking about your trading revenue, I know you said that was a weak spot in the last quarter, but when we're hearing from the big banks, the volatility has actually boosted their trading revenue because people are coming to professionals and experts looking for help. Do you expect that to improve as the year goes on and hypothetically we get more certainty about trade policy and tariff policy?
Certainly, as you get more certainty, that category will improve. I think for us, what's different than the money center banks is we don't have the equity trading or the foreign currency trading. Ours is really mortgage-backed securities trading. So it's a smaller sliver of that trading segment. And so where the larger money center banks have performed very well is really on the equity and foreign currency side of it with all of the volatility in the markets. the fixed income side has struggled, and other banks as well. And we were certainly no different. I think if you look at where customers value our advice and counsel is really on the fiduciary side, where we're helping manage their retirement assets or their foundation or other assets. We've got 115 billion in assets that we manage for others. So that trusted advisor role that we play is really heightened in an environment like this, where we can provide great counsel to our clients around what to do in this environment.